This is a Momentum Media production.
Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase. Well, g'day everyone and welcome back to another instalment of the Property Showcase. I'm your host, Tom Gilmore, Media and Marketing Lead here at smartpropertyinvestment.com.au. Guys, today's topic is going to be about killing the most common investing risks and mistakes with these 5 tips. The gentleman to help me break down this topic today is a fan favourite of ours, and the reason why we bring him back on consistently is because his in-depth knowledge of the industry is second to none. I've seen this bloke help loads of punters like yourself and me who invest in property across the nation, and what he does for his clients is just truly spectacular, and what he's continuing to do into the future is also something something to watch. He is the director of InvestorKit. He is also the host of the Property Nerds, which is another podcast we've got going on here at the Smart Property Investment Podcast Network. If you haven't listened to it, give it a shout out. He honestly brings me smiles every single day, just like a kid receiving a Snickers bar for the first time at the age of 5. And today he's going to help us unpack this topic. Arjun, mate, how you going?
And if you paused any longer on that intro of killing, it would have been an odd episode, wouldn't it be?
Yeah, well,
my friend, thank you so much for the intro.
Yeah, no problem. We'll have to make sure we don't do any pauses on that intro. It's, thank God there's no edits, right? Thanks, James. Mate, this is a pretty interesting topic. Now, I've got these 5 points down here that we're going to run through today. I'm going to be straight up with you. The last one, I'm not going to say it, but the last one is a bit of a tickler for me, and I can't wait to unpack in what you mean and how you're going to interpret this. But it's something I've heard quite often, and it's something that I apply to, I suppose, my own personal investing strategy and thoughts as well. So I just wanted to start with the top one. Pressure equals low risk and high chances of success. What does this point mean, Arjun?
Yeah, Tom. So, the whole idea, firstly, of killing the most common investing risks and mistakes. I guess I started off with what are the things that I would like for a property to do for me? And the 3 most important things are it grows in value, rents quickly, and rents for a good amount. And the beauty of these 3 things is, well, guess what? You don't want the opposite of that if you're trying to kill the risk. And that's where whenever someone has risk come up, it's usually the opposite of these 3 things has happened. Maybe it's not rented so quickly. Maybe you didn't rent for a good amount. Or perhaps it hasn't been growing, which makes people rethink investing and what they're doing. So in this case, market pressure is the saving tool for investors to really kill that risk. And this is a common part as well where I see mistakes are made, because too often people get focused on the property deal. The deal is not what it's about. It's the market, because you can go have a great deal and it might be a little bit of a sugar rush at the start. 20, 30K cheaper, 40K cheaper. But remember, it will be a comparable sale now. Is that next person going to react off your so-called deal and think that that's what they should pay? Or is that person going to see that as an anomaly and they continue to pay higher prices? I prefer not to take my chances on trying to find deals everywhere, because if you do, you might actually be stuck in a market that's offering too many deals and not displaying the right pressure. So, Tom, this is where pressure helps us say that there's probably less deals out there, quote unquote, but there are more properties that are seeing many people fight over it for rent and many people fight over it for sale. And this is what causes property prices to increase. So I put it down to a few indicators that can sort of show the writing on the wall. And the beauty about using indicators is that, yes, while it's just a starting point for numbers, it does mean that we can pick out trends. And it does mean that you can actually say that there's a high chance of people fighting over property. And that's what creates capital growth in the sooner rather than later. Some core data points, for example, are what we call inventory levels, which is a combination of how many listings there are in comparison to how much sales are happening in an area, the beautiful demand and supply, as we like to call it. Mm-hmm. But this is a singular indicator that puts the two together. And when we tend to see lower inventory, So example, if there is 30 listings online and it takes 10 sales per month on average, we would suggest that there's 3 months, of inventory there, because in 3 months of sales, it should clear everything that's online. That would be a really high pressure market. So that lower the inventory score, we do tend to see capital growth happen sooner. So that's one of the first key points. Other core things are days on market, the speed in which something is selling, vacancy rates, job advertisements, vendor discounting, the list goes on. But what we're really talking about here is not to go out and chase the deal. It's to chase the market that shows high pressure, because you're going to massively reduce risks and mistakes when someone else is fighting for the next place and someone else is fighting for your rental property. That's what equals results for investors, not the sweet sugar rush of some sort of cheap or discounted deal.
So I suppose that's quite relatable to what's happening or has been happening all year. And in my thoughts, in my silly little thoughts, I know nothing. I'm not the expert, you are. How can we relate this to the roadmap that we now have of freedom? Is there's obviously more increases, there going to be more boots on the ground? Is this now more a stressful time? And do you think more people are going to be using exactly what you just said and thinking more about the deal when they shouldn't be thinking about the deal?
Yeah, Tom, you've hit that right on the head, because if you're focusing on a deal in this current market, you're going to make one of a few mistakes, right? So the first mistake I think of is that to find the deal, you're likely going to go to somewhere that has very low pressure. And you're going to find somewhere that the vendor is willing to, sell it for less, or it's taking longer to sell, or they're willing to give it off market in an area because they don't think they'll get something as well on market. So this is where you can now make the mistake in the market you're chasing to somehow get the deal, because you think the broad headlines of properties rising are universal, which is not always the case. The second mistake that could come up, Tom, in trying to chase the deal is that you might not know why it's that much cheaper, and you might have missed something on your due diligence. Could it be in a neighborhood, or could it be on a main road? Could it be impacted by some sort of bushfire, flood zone, or something that you're not as familiar with, being new to the market and you're taken for a ride?
Absolutely.
And so as a result, this is where quite often the great deals do have some risks come up on them. That's the case in high pressure markets. In your kind of earlier phases of markets, which isn't a high frequency during this current environment we're in, yes, the deals can come up. Yes, you can start to see some sweet numbers. But the truth is, the real results sit in the market that you're operating in, not always the deal that you're buying.
Yep. Great. Second point here. Don't buy new in high growth areas. Can you expand upon that?
So this is interesting, Tom. I'm going to probably annoy a lot of people on the whole don't buy new, because it seems so easy and seems so good when it comes to the maintenance and the depreciation. But then also high growth areas. This is where commonly people think that high growth areas is great capital growth, when in actual fact, high growth areas are referring to lots of population coming in, lots of infrastructure spend. But both of these tend to happen when there's lots of building occurring. Right?
And are you saying that when people read this, they're interpreting the information in a different, probably much largely than what it actually is supposedly saying?
Totally. So the whole idea of I'm going to buy new, there's lots of properties being built, the area's changing. Remember, change isn't necessarily a good thing when it comes to an area, because it usually is saying that a lot more building is happening. Now, it's great to recognize a city like, hey, wow, 10 years ago, there was nothing here. That's great from a conversational point of view, but it doesn't always change your performance when it comes to capital growth. And, just to give you some examples of population and its impact as an example of high growth, I've jumped on this topic before of the Gold Coast market. Between 2012 and 2016, the suburb of Highland Park in Gold Coast was fairly established, not many new buildings coming on, not many new pieces of infrastructure that suggest it's high growth or lots of new property. And yet during that time, its population grew just 0.2% over that 5-year period. But its median house price grew by 26.5% during that same period. The same market, a different suburb, Hope Island, during that same time had population growth of 31.9%. Many new builds, many high growth terminology of population, great lifestyle, lots of amenities, new projects coming up. It sounds like the dream location to live in. It's probably not that bad to live in anyway. But from a capital growth perspective, prices stayed pretty similar over that 5-year period, although another suburb in the same city moved astronomically. So this is just a example of how high growth does tend to mean higher supply, and newer properties in high growth areas also tend to mean higher supply, unless the builders are in this perfect world of everyone's buying up all their stock and constantly upstaging their prices, and it's only them largely operating in that market, not many other developers who can counteract that pricing. It's probably going to be the odds stacked against you, just because that high growth area doesn't always mean high capital growth, tends to be higher supply. And this example is also the same on a macro sense. One would suggest that, the greater Hobart market that moved 50% between 2012 to 2020 in capital growth, one would think that must have been a high growth area with lots happening. Well, not the case at all. Population only grew by 9.7%, whereas Greater Darwin grew by more than Greater Hobart, and its prices moved backwards during the same time. So I would just question the whole, I'm going to go buy a new property in this great high growth area with so much change. Change is an emotional connection. It feels great to see that happen. I'm sure there'd be lovely restaurants and shops and things and all that there, but that doesn't have any correlation to your property prices rising.
Yep, completely agreed. Mate, number 3, buy a house. Now, not buy a boat, and I'm guessing what you mean by this, don't buy an apartment, buy a house.
So buying a house, right? Seems pretty simple. Hey, you want to stop your risk? You want to kill some risk? Just buy a house. You're probably going to look, I'm making up this number right now, but you're probably going to increase your success by 50% or twofold or threefold just by buying a house, right? Now, many people fall for the trap of the great amenities, the lifestyle, and so forth. But again, similar to our previous point, even in areas that look built out, that look like everything's there, the risk of the apartment is that the sky is for anyone. Many properties can come up and go into the air, even when the property seems, or the area seems built out. So in a built out area, if you are buying a house, you massively increase your chances now, because you can't really put more houses in unless there's infill subdivision, which even in that case might actually increase your dollar per square meter rates. But when it comes to the apartments, they can just keep coming as that zoning level changes. Now, if apartments are coming up, Tom, whilst you've got a house in the area, that may also positively impact your dollar per square meter rates. But buying a house is a great foundation for a portfolio to be able to just help you reduce that risk and kill that risk, as we said earlier. Now, when I do look at units and townhouses, I wouldn't say that it's an end all and you can't have property success within that.
It's
but
not
what I am
either.
saying is the odds are stacked against you. That's the key thing to note.
Yep, I agree. And some people listening to this who I have spoken on occasion, I do sometimes get to meet our listeners, and they know I'm pretty against the old apartment, not even just after the typical standard saying of buying an apartment after the year 2000. I'm just so against it because you've got no opportunity. You can't put a granny flat behind an apartment. There's so many things that you just can't control. And I hate that idea. I can't stand that idea. So I completely agree with you. I'm a house all the way for many different reasons. But that's really, really good insight.
On that house thing in apartment, Tom, as well, I have to pull out some bias on that, which is I have bought an apartment block before. And the apartment block was a completely different story to an apartment individually.
Yeah.
Because the area that I bought it in would just be disgusted by multi-level buildings. So they just, they don't want skyscrapers everywhere. This is a very quiet and profitable regional city. And in this city, I found that, the zoning limitations and restrictions will help here because there's not going to be a whole bunch of apartments come up. But at the same time, because I'm buying the whole block, I'm controlling the land like a house owner. Yep. So if zoning or any other things come up, you're actually in advantage now because you can move with it. Whereas if you're one apartment amongst a building, you're just kind of stuck and sandwiched in. You got to just go with and hoping how the market performs.
Yep, completely agree. I mean, that is a very case-by-case basis to have those types of opportunities, and they are applicable to everyone once you're in the right scenario. But I think, obviously just from an individual perspective, of just buying one apartment inside of a block. It's I'm just so against it. It's just not worth it, especially in the long run, in my opinion. But number 4, more locations, the better. What does that mean?
Yeah, so this is a huge part to buying, not only just general, but in the current market as well. One thing I can just share as an example is that many people will probably have Brisbane on their radar right now. Yes, they might be a little bit late to the party that started its growth phase, I would say, 2 years ago. But the key here is that they see one market, they speak to a friend about a market, and all eyes are just set on the Brisbane market. Now, the problem here with that is if you don't cast your scope wide enough, what's going to happen is you're going to miss out on many opportunities that could have performed either better or given you many more properties within your price range. Some people assume that the Brisbane market's performing, so they might take their 400, 500K budget and go, look, I'll just buy anywhere with this because I assume that the whole city is rising.
Yep.
In some markets, this may work out well, but there are definitely 2 or 3 speed markets happening in parts of Brisbane as we speak. And not all suburbs will deliver what some other suburbs have over the next 12 to 24 months. So from this perspective, an investor needs to be as wide as they can, because if you kept focusing on one market, we can take an example here of the Sydney versus Shepparton example, or the Sydney versus Hobart example. If we analyze price trends for the Greater Sydney region, between 2012 and 2017, there was a whopping 65% capital growth. This is huge. However, if you felt that looking back at that 12.9% per annum average, that this is fantastic, it's growing, I'm going to buy in Sydney because that's where it's growing, and you start to jump in at 2017, which was the previous peak before the now new one, there was 15% of growth in between that. Now, that's not a lot of growth when you're thinking 4 years, depending on where you buy in Sydney. If you flip it on its head and now go, well, no, I don't want to just look at one city. That is a great city that's had some phenomenal growth in the past. I want to make sure I'm looking all over. And at 2017, if you had chosen Hobart instead, you would have had 55% growth in the following 4 years, which is just phenomenal. Or you would have had close to 30% growth, 31.4% in Shepparton, if you'd gone to there over 2017. Now, I don't know very many investors who are sitting in Sydney and going, I'm now going to all of a sudden look at Shepparton, being in such a major city, seeing all this growth and activity happen around you, and you all of a sudden zone in on a smaller town, sub 100,000 population in regional Victoria. So this is the challenge that I want to give investors. Be wide, look at multiple markets. There are so many areas that have outperformed some of the cities that we love in given moments of time. And if you want to reduce your risk, how you have the performance for the next 2 or 3 years is very important, because this will set you up with your confidence for investing in more properties.
Absolutely, especially if you want to scale so quickly as well, especially over a 5-year period.
Exactly, right? And confidence at the first few, think of all the investors who don't go on to scale a portfolio. It usually goes back to having a sour first go. And so if you're going to buy in a market that has really, had some great growth and is really biased by where you live or who your friends are and what they're doing or what you saw in the news, and you just want to stick to your guns with one city, you are increasing the chances for it to be a sour taste in your mouth if you look back the 3 years afterwards and don't see a good result. Whereas if you really open up that scope and say, I'm making an investment here and I need to be wide open to what's happening across this country. And this is where professionals can come in, which is what we do for clients. But it just means that you're going to have an opportunity to really see it all, reduce the risk by going to areas again of high pressure, not just where everyone's saying to go.
Yep, I completely agree. Mate, point number 5. Now, I'm just going to give a little bit of an insight as to why, this is so paramount to me. And you wouldn't believe who I actually learnt this off. It's just some bloke by the name of Arjun. I learnt this probably about 3 years ago. Now, you've said it differently here, but the way I will say it and the way I heard you say it is you don't have to buy expensive to buy good. And what you've said here is price isn't quality. Can you expand upon that? Also, am I right?
Yeah, you're spot on. So that was a pretty cool. I think we did a webcast together on that, right?
Yep.
Don't need to buy expensive to buy good.
Love it. Mate, that quote has stuck with me for years.
Oh, and it's looking back at my own journey or what my clients have received in terms of the last few years as well, totally agree. This is a perfect, trip up mistake that investors make, because sometimes if you go and buy a $1 to $2 million property and you see $100,000 uplift, in your mind, you're thinking of your $100,000.
Mm-hmm.
In a percentage view, call that 10% or 5%. That same percentage can be much greater in other areas if you're, again, opening your scope wide. And we take that Shepperton example for 31% between 2017 and 2021. An investor may not realize that 31% is so substantial, because it might be, say, a 250K property moving to 350.
Yep.
Or just under. And so it's the same 100K, but that might have happened in 1 year in that 1 to 2 mil example, because it's 5 to 10%. Now, this is where the dollar value of purchases can trick the mind. What if you were to buy 3 or 4 different properties like that Shepperton example in different locations, one in Shepperton, maybe one in Burnie, one in Victor Harbor or Barossa Valley, something that's achieved these results, and you start to see this change. Overall, the portfolios reach that same $1.2 or $2 million number, and it will start to give you those same big dollars when you look at it holistically.
Yep.
But people sometimes miss out on that, and they think, well, no, because it's not by the water, not near all the amenities, not in a highly sought after school catchment, or not an expensive area, am I making an inferior decision? Well, no, you're not, because risk mitigation is part of, quality, in my opinion, when buying properties. And if you're getting affordable properties that rent pretty well, rent for a good amount, and grow, and you do that multiple times over, if it still equals the same portfolio value, can actually be a more enhanced decision, because now you've got your risk spread.
Yep.
You've also got greater rental income, and you're still achieving similar growth. So price is definitely not quality. I mean, in my particular example in Bendigo, that would be another one where I say a 380K property that's moved up to close to 500,000 in 1 year. The investor who felt that, no, I need to buy a more expensive property and save up more, or not go for that because it's a cheaper property, would have missed out on those gains, would have missed out on that risk reduction from the rental that was quite high, and the ability to enter a market with a smaller purchase price. So yeah, price is definitely not quality when it comes to investing. There can be great decisions made at 1 and 2 million. There can be great decisions made at 3 to 500K.
Yep. I completely agree with you. I want to tie this now into sort of, I suppose, on a finishing point. The roadmap to freedom is now here, at least for New South Wales, obviously, which is where you and I reside. The pressure and stress that I suppose you and I are going to feel, and the rest of the population who are trying to get into the property market. Look, things have been hectic all year, but, applying what we've just spoken about here today into what we're about to face over the next 3 months, is there any further advice or any sort of further tip, or, the gold tip on sort of how to applying this 5 points into the current market?
Yeah, so with the 5 points mentioned, they touch more on a generic market trend of looking at market pressure, buying houses. Price doesn't necessarily mean quality, not buying necessarily in these growth areas and so forth. So these are some generic points. If I was to bring it down to a specific property level when someone's, trying to make a purchase, the key here more than ever for people is what we call comparable analysis, results, and review, right? Because when you start purchasing properties, the sales that have happened 3 and 6 months ago, in my opinion, are very stale. And, the last thing someone wants is a very high stress environment after missing out constantly, and then seeing so many properties come up, then get taken away during this busier seasonal period, especially as we start opening up. And so there might be a greater turnover of properties as we start opening up, but that doesn't necessarily mean that there's a greater chance for you to win, because that turnover could be high at high speeds. So this week, 10 properties come up, and you may miss out on all 10, and then you have to wait for the next week. It might not be 10 properties come up, of which 3 or 4 keep staying on the market. And so as a result, then you come towards the tail end of the year, you're thinking about all the fun family time, the seasonal times, the new year. Is it the right time to buy now? What about finding a tenant? People are traveling, people are not traveling. So all these things go through your mind and you might rush it, completely overpay, and make a bad decision. So all I'd say is in this time period, make that call to agents for properties that are under offer. Let's try and get a really good grasp on what the most recent assets are selling for. They might not give you the exact amount, but play your game to try and figure out where is this landing. Other things is fast forward results. So if you had something sell for 600K last month and it's moved 1% to 2%, you can't imagine that your similar property will also get it for 600K. It actually may move to 606 to 615.
Yep.
You've got to anticipate some of these movements. You've got to really get detailed in your analysis. The little things matter: interior, exterior, land size, fixtures, fittings, the X factors, the neighborhood it sits in, how many people attended opens, all these different things. You really need to get more detailed than ever, have a really well-rounded comparable analysis, because I'd hate to see people go through this period of constant missing out week on week on week, come towards the tail end of this year, and they start making some pretty silly decisions on what they're willing to pay for a property.
Yep, completely agree. Well, Arjun, to all the listeners out there who may be struggling or, want to challenge you on the information that you just said, how do people get in touch with you?
Yeah, so the best way to get in touch with us is definitely through our website, InvestorKit.com.au. Loads of information about some of the research that we've done and the processes that we follow, what clients are saying about us, but also if you'd like to use a professional service such as our buyer's agency to scale your portfolio or start it, this is where we specialize in helping investors scale their property portfolio using our experience and research capabilities.
Absolutely. And guys, if you just want to hear more of Arjun and none of me, he actually has his own show on the Smart Property Investment Podcast Network called The Property Nerds. And if you really like the way he speaks, the way he thinks, the way he acts, the way he dresses himself, please go listen to that show. It is an excellent breakdown, episode per episode, on different things happening in the market, different areas of the market. And the way Arjun explains it in detail is honestly second to none. So if you enjoy that content, you like the research, you like the data, it's, the property nerds, they are nerds for a reason, please go ahead and listen to that as well on smartpropertyinvestment.com.au/podcasts, the property nerds. Arjun, mate, today has been absolutely phenomenal and thank you for joining us.
Thank you, Tom. Appreciate it.
Cheers, mate.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.